right. Happy GDP Day, everybody. Today is the day we get our third quarter GDP release, and it's looking like the number, at least all the initial estimates, are looking pretty good. The Atlanta Fed's GDPNow tool is predicting 3.1% economic growth for the third quarter, which would mean a technical end to our technical not recession that we have not been technically for the last 9 months. So you tell me, is it the end of the recession? Were we never in a recession to begin with? Or, I don't know. Your guess is as good as mine, folks. I was looking through some of the data this morning. Me and my moderator, Mish, were going through some of this stuff, and we're just scratching our heads. How could the numbers be this good? Everything you look at, every small business owner you talk to, every story, it seems like there's just economic mayhem everywhere, and yet they're saying we're in this big expansionary period, apparently. But when we looked into some of the numbers, it started to make a little bit of sense. I think what we're looking at here, if the number does come in positive, we're probably looking at a very temporary positive thing, because there's a couple of things going on beneath the surface in the data that are skewing the numbers upward. I'm not sitting here saying that these numbers are false outright or anything. It's too easy to do that. It's too easy to just say, oh, they lie. You actually have to dig into the headlines and look at some of the numbers. And I think there's a couple of things going on that are driving this. But let's bring in my man Mish the mod, and let's look at some of this information anyway, just to see what's going on. I just got one of those alerts that scares the crap out of everybody with a license plate number. That's always fun. Hey, yeah. Mish, how you doing? That's an intro, isn't it?
How you doing?
I am doing very good. And folks, if you're looking at the screen right now, this is BEA.gov, or the Bureau of Economic Analysis. That is where this information is going to be released. And real quick, Mish, let's have this conversation we were having a little earlier, because it was pretty good. We were talking about what happens if the number comes in as expected, and then we have a good GDP number, we grow by a few percent, versus what happens if GDP comes in negative and we get an unexpected third quarter of negative growth. So give me your take first, Mish. Let's say we get the 3% growth that GDPNow is calling for. What do you think happens in the market?
I think that if we come in at 3.1, the market tanks. I think if we come in negative, the market tanks. I think if we come in somewhere in the 1% range, I think we stay where we're at. And here's why. You notice I didn't say go up on any of those.
Yep.
Because if it's hugely positive, we're heating up. That's the story to keep it at 75 basis points. Market will not like that. If we're negative, that's 3 quarters of negative growth. That actually makes people look at this and go, well, shit. So somewhere in between, I think, in the low ones is kind of where it stays. There's an argument that if we go like 1.5 to 2, the market might get a bump, but that is my opinion.
That's solid. So you're saying we have a needle to thread here. Too high bad, too low bad, just in the middle, just right.
Market through the eye of the needle.
Okay. So I have a slightly different take on it. I think if we come in as high as they're expecting, I think the market tanks on that news. I think a red hot GDP, because right now earnings don't matter, nothing matters, math doesn't matter. It's just Fed good, Fed bad. That's all. Nobody knows what anything is really worth. If the Fed is going to tighten, things are going to go down in value. If the Fed is going to loosen, things are going to go up in value. And it's this silly binary thing going on because the central banks are rigging markets. So if we get this blowout number, positive 3%, I think that means a more aggressive Fed. Market won't like that. If we get a deeply negative number, signaling further economic contraction, I think stocks rip higher on that news, because that means Jay Powell is finally getting what he wants. The economy is slowing down, and so he might ease off a little bit on the rope that he's currently using to try to choke out the economy. So deeply negative, I think stocks rally. Deeply positive, stocks tank. If we get into your sweet spot, like you were talking about, I think we get probably a no move, a no never mind. Not a very big reaction to that. So
Now, we do have some outliers out there that are gonna come in at the same time, which we may not cover too heavily, but those may have a play in the factoring too, and I'll take a
yep.
look at those when we come out.
We're also going to get PCE is going to come out today. Personal consumption expenditures. That's the Fed's preferred measure of inflation. So that's one thing that could affect what the Federal Reserve does from here. Real quick, let's take a little bit of look at the expectations. This is the Atlanta Fed's GDPNow website that I'm looking at here, and this chart is just showing what the projections for economic growth this quarter have been over the last few months. And I know this is kind of hard to see. Let me zoom in a little bit here on this chart. You can see it was right about mid-September. All of a sudden, all of the data that goes into this math started bringing the estimates higher, and it's just gone higher ever since. And I've been really sitting around and trying to figure out what is going on that all of a sudden these GDP estimates are so much higher. And you have to go back to the GDP formula, right? And GDP now is saying 3.1% growth this quarter. So here's all the factors that make up gross domestic product, the sum of all goods and services in the economy. And the biggest one by far is that first one, personal and public consumption. That we are a consumer driven economy. How much crap did you buy at Walmart? Did you buy at Target? Right? That is the economy right there. There's other factors, but that's the big one. All right. And if you want to know what's going on in the big one, here's a chart that I've brought up a couple of times recently. This is on the St. Louis Fed website. This is consumer credit in the United States. This is all credit cards, lines of credit at stores, revolving debt. All right. This is Americans putting the cost of inflation on the credit card. All right. And if you see, this was the unfortunate health situation in 2020. Credit card debt was pretty high. Everybody got locked inside. They couldn't go out to eat. They couldn't go on vacation. They couldn't do anything. Plus, they got all the stimmies, so people got out of debt, right? And then all of a sudden, in mid 2021, with the reopening, people started putting life on the credit card debt again, started going up. Then inflation hit mid last year, and this line got a little steeper. And now credit card debt in the United States is at an all-time high, which is surely not a problem for any of you melon heads watching at home, right? Because we don't do that here on this channel. We stay out of debt. We stay out of adjustable rate debt. If you're watching a channel looking to make an investment or wondering where to put your money and you're carrying credit card debt, you're already in the wrong space, by the way, folks. Get out of credit card debt before those interest rates rise higher. But to my point, American consumers have not adjusted their standard of living to accommodate for this runaway inflation. The headline inflation number is 8.2% right now. It was high as 9.1%. But if you actually look at the cost of living, not the government statistics, the cost of living has gone up closer to 20% on average. And right now, Americans are making up that difference. It's not coming from wages because wages have only risen 5%. It's coming from the credit card. So that is artificially skewing GDP higher. It's the illusion of prosperity, and what it really is just delayed pain, right? We have to pay that bill eventually, and the cost of carrying that debt is going up also. So that's one factor I think that could explain why these GDP numbers and these estimates are so high right now, because personal consumption is the lion's share of GDP. It's something like 60 or 70% of total GDP is personal and public consumption, and right now debt spending is driving that. Another big one is government expenditures. We've had a lot of discretionary spending from the government in this last quarter, right? We had the CHIPS Act, we had the Inflation Reduction Act, a lot of new spending packages. It seems like every day there's another couple of billion that are going over to Eastern Europe, right? So government spending is also up. That will drive the GDP number higher. Public and private investment, that's capital expenditures, and that also includes inventories. And a lot of retailers right now, we're seeing a lot of headlines about inventory growth all over the country, about how Target and Walmart are canceling orders by the billions because their inventory is getting out of control and they're trying to sell down their inventory. Well, if inventory is growing, that looks like GDP growth. So that's another reason that could be taking these GDP numbers higher. It's not necessarily an indicator of prosperity, but there it is. And lastly, you've got exports minus imports, otherwise known as the trade deficit. right? The United States operates at a large trade deficit. We import way more than we export. Well, there's something that's been going on in energy markets you may be familiar with, and that is the dumping of the Strategic Petroleum Reserve. We've been dumping 1 million barrels of oil per day from the Strategic Petroleum Reserve into the open market here in the States. That's oil that we are not importing because we're taking it out of our storage and we're burning it here. And so, because we're not importing that extra million barrels a day, well, we're getting a slightly smaller negative here in the imports category. That will skew GDP higher. On top of that, there's headlines about we're actually starting to export small amounts of this oil, that the oil from the SPR that we're dumping is ending up being exported, and we're exporting a lot of refined petroleum products like diesel, even though inventories of diesel are tragically low for this time of year. So that will be skewing the exports number higher. So the dumping of the SPR, besides manipulating energy markets, it's also going to send GDP numbers higher. So when you actually break down this formula by category and you start to look for why these numbers might be positive, yeah, I mean, this is real. You know, if we actually do have a plus 2% or a plus 3% GDP number, then there are legitimate mathematical ways to explain that you don't have to just say, oh, the government lies about everything. Nah, I can actually see it in the data here. Right, here is the Strategic Petroleum Reserve, right? You see this big downward drop right here. That's all the oil that the Biden administration has dumped in the open market over the last few months. And you're talking a few 100 million barrels of oil. That's a lot of money. That's a lot of oil we didn't have to import. And at what, $85 a barrel on average? Yeah, that will make a sizable change. That's worth a couple of tenths of a percent in GDP. Absolutely. So it's just something to think about, folks. We are now 3 minutes away from the GDPNow numbers coming in. We will be refreshing this once we get closer. Real quick, just want to look back. This is the second quarter GDP number. And in the second quarter, we had grown by 0.6%. And I'm sorry, not grown. We had shrunk. We contracted by 0.6% in the second quarter. And we contracted by negative 1.6% in the first quarter. Now, I also want to add that this is the initial estimate that comes out today. They do 3 reports for GDP. The initial one comes out today, and then we'll have a second one in a few weeks, and then the final one a month or two from now.
I would like to point out that the second quarter numbers didn't change once they came out, but what first quarter did.
That's correct. I think the initial release, the second quarter initially was released as negative 0.9. On the second release, it was negative 0.6, and on the third, it stayed at negative 0.6. So it didn't change with the final revision. There was one revision to it, but it wasn't enough to bring it positive. The first quarter was initially reported as negative 1.4, and then in the subsequent revisions, they lowered it to negative 1.5 and then negative 1.6. So usually the initial report is pretty close. It's in the ballpark. It changes, but it doesn't change by that much. Right, so if we get a positive 3% number, it's not going to go negative with the next 2 revisions. That would be catastrophic for the reputation of the BEA if something like that were to happen. Let's just put it that way. All right, 2 minutes out. Real quick, speaking of GDP, we have had just god-awful earnings reports from Google, Alphabet, Facebook, Meta, and Snapchat. All right. 3 tech companies. Snap is nowhere near the size of Google and Alphabet, but I mentioned Snap because all 3 of those companies are big digital advertisers. That's their bread and butter. That's how they make their money. And all 3 just reported absolutely horrendous quarters for their third quarter over these last few days. That is not a good indicator for the health of the economy. If everyone and their brother is cutting back their advertising spend, that means those businesses are not doing very well. So I just mentioned that because if they're cutting back on their spend, it means they're not doing as much business. And another thing is we had really good earnings from Visa came out. I think it was yesterday. Well, that kind of goes along with what we were talking about, how Americans are putting life on the credit card. So when you see a good earnings report from Visa, MasterCard comes out later today. If you see a good report from MasterCard, that is not necessarily a good thing for the U.S. economy. That means Americans are putting life on the card. That means they're going further in debt, Remember, credit card debt, that's adjustable rate debt. That is not something you want to be carrying. All right,
It's
it is
out.
8:30 right now, and here we go. Gross domestic product for the third quarter, real GDP increased at an annual rate of 2.6% in the third quarter of 2022, in contrast to a decrease of 0.6%. So our not recession is over slash not over, however you want to look at it. 2.6% economic growth. Let's put that here on my little, where'd you go? GDP up 2.6%. I'm going to flash that one on the screen right there. Breaking Q3 GDP. All right, let's open up the report and see where the growth came from. Look at the current release. All right, real gross domestic product up 2.6%. According to the Bureau of Economic Analysis, the GDP estimate released today is based on source data that are incomplete or subject to further revision. We talked about that. The second estimate will be released on November 30th. All right, here is this chart that they're showing in the release. Each one of these bars represents a prior quarter. You can see here just barely negative the last quarter, and then there's the first quarter number, and then these two big outliers here. That is the massive drawdown we saw in GDP with the pandemic, and then the massive blowout we saw in GDP with all the stimmies and all the government money printing. And now here we are kind of sorting our way out from there. All right, the initial increase or the increase in real GDP reflected increases in exports, namely, I'm guessing liquefied natural gas is probably the big driver of that increase in exports. We're selling a lot of LNG to Europe. Increases in consumer spending, we talked about. Non-residential fixed investment, i.e. inventory growth, federal government spending, and state and local government spending that were partly offset by decreases in residential fixed investment and private inventory investment. That's interesting. Now, the residential fixed investment, I can see that. The housing market, people are not putting, they're not upgrading their bathrooms. They're not putting money into their house like they were 2 years ago. Imports, which are a subtraction in the calculation of GDP, decreased. We talked about how imports would be decreasing because of the dumping of the SPR. The increase in exports reflected increases in both goods and services. Within exports of goods, the leading contributors to the increase were industrial supplies and materials, notably petroleum products, as well as other non-durable goods and non-automotive capital goods. Interesting. Within exports of services, the increase was led by travel and other business services. That's curious because I noticed in the Visa earnings report, there was a lot of mention of increases in travel spending. People are going on vacation, I guess, before the second Great Depression hits. Might as well go on that big expensive vacation and put it on the credit card. Why not? Sure.
Well, that
Don't
actually
do
makes
that, folks.
sense with PCE. PCE came in 3% lower than it has been running.
3% lower than it's been running. So we've had a big
Right.
decrease in PCE.
Right. So it was 7% and it just came in at 4%.
Okay. Now PCE also, I believe, has a big energy input into it, and PCE. Correct me if I'm wrong, Mitch. This is a quarterly number that comes
It
out in the
is.
PCE. So consider that like a roll up of your last three CPI reports, where we went from 9.1 down to 8.2. A lot of that, June, July, August. No, I'm sorry, July, August, September. The average price of a barrel of oil went from something like $100 a barrel all the way down to, I think, 78 was where we bottomed out. So
Yep.
a lot of energy reflected in that PCE number. I wouldn't read too heavily into that, but that
I
is,
read into it because of the GDP services expenditures.
yep. And also, gasoline, right? That's that's the big one. The price of a gallon of gasoline has really substantially come down from it was here in Pennsylvania. We have really high Pennsylvania gas taxes. We were over $4.50 a gallon back in April May timeframe. I mean, I think 460 was the highest I saw out here, and we got down pretty low, like 320 a gallon. Now we're back up. We're just below $4 a gallon out here, just below $4 a gallon. Where like the last time I filled my tank, it was like 397, and I remember saying, I was like, this is going to decide the Senate race in Pennsylvania. If we get to $4 a gallon, that four handle is going to be a psychological shock, and that's going to
Yeah.
be enough to put Dr. Oz ahead. Let's not get into that mess. What an absolute circus the Pennsylvania Senate race is. But I digress. All right,
Yeah,
let's look a
before we
little.
get into rest of this real quick,
Okay,
continuing claims was up a lot
continuing
again,
jobless claims was up a lot.
2 weeks in a row.
Okay, that's interesting. Let's look at that. So you're saying continuous. Let's bring that up. I have the economic calendar here. Oh yeah. Look at that. For now, this is a weekly snapshot. Continuing jobless claims. Now,
This is
explain
the
real
one you
quick.
gotta watch.
Continuing. Go ahead, Mish.
I was gonna say, this is the one you have to watch because continuing means all these people quitting or no longer finding that job right away.
Yep. And
So a
also,
big
correct me if I'm
uptick in
wrong.
this. Mhm.
Correct me if I'm wrong. Initial jobless claims don't really affect unemployment. 4 week doesn't. They don't really count in the unemployment indicator until they're into this category. Is that correct?
Yes, that's
Okay.
the easy answer.
All right. That's easy. I know there's a lot more nuance to it. Absolutely. But the employment numbers, to Mish's point, they are delayed reports. They're backward looking snapshots. So a big uptick in continuing jobless claims could indicate an uptick in unemployment on the horizon.
Mhm.
And yeah, that is a pretty big change, especially considering we had some really low numbers the last couple of weeks. But they increased to 14,300 and I'm sorry, 1,438 for the week ending October 15th from 1383 the previous week. So that's a pretty substantial jump now. And just looking back, although if you look at a 5 year average, nowhere near what we saw during the pandemic. But that's a pretty big change in the employment system still. So we'll be keeping an eye on that one. Let's see how the indexes are reacting right now. This is looking at Dow futures, currently set to open up 300 points. Although they've been heading that way for quite a while now. Let's put this on a 1 day chart here. A little bit of a change. We're seeing some green candles here, but no real big reaction to this unemployment report. That's interesting. Let's see. The S&P is again a little bit of an uptake, a little bit of a big green arrow up, but you can see it's heading right back down now. By the way, I usually tell people don't try to trade around data reports like this because there's a lot of algorithmic buying and selling going on right now. People program parameters into software and billions of dollars, hundreds of millions of dollars is traded based on key data points or numbers that appear, lines of text that appear within a certain article. You're not going to be able to react in real time with something like that. So, not a financial advisor, not financial advice, but I always like to just take my hands off after a CPI read, after a Fed press conference, or after a GDP release. I put my trades in either ahead or and I just sit back and watch for the first few hours, even for the first day or two. Because you could have 1,000 point up and then 1,000 point right back down, and it's all just machines arm wrestling each other. Anyways, the S&P is right now just barely positive, up 5 points or 0.15%, and the Nasdaq is actually negative right now, or down 55 points or 0.48%. So market can't quite make up its mind what it wants to think about this GDP number. That's interesting. I would expect the market to be heading lower right now. Economic growth means the Fed is not being successful with cooling down what they see as an overheated economy. Now, I don't personally subscribe to the Fed's line of thinking, right? I don't buy that raising interest rates and putting people out of business and putting people out of work is how you fix the economy. That's not It's a very Keynesian demand side way to look at things. I don't agree with it. Um, but regardless, economic growth means that the rate hikes are not being successful based on the terms that Jerome Powell has laid out. He wants to see spending come down. He wants to see demand come in line with supply. Right now, the demand for most things, including labor and goods and services, is higher than the supply is. So he's trying to slow down the economy to reduce the demand, i.e., he's trying to make people poorer so they can't afford that stuff, so the demand comes down and the prices stop rising. Again, that's not how I would do it. This is Jerome Powell's own words. So the fact that we've got 2.6% economic growth now says, hey, these rate hikes are not having the desired effect on target. So maybe we need to keep at it a little longer, or maybe even, dare I say, increase. I don't think they're going to increase, but it's It's interesting. I would expect a bigger reaction out of markets than this. Let's see what the US dollar is doing. The DXY, or the US dollar index, right now is at 110. It's up about 75 basis points, which is a pretty big move up for the US dollar. But keep this in mind, this is after a week of the dollar getting just absolutely brutalized by these overseas central banks that have been defending their currencies. You've had the Bank of Japan has been defending the yen against the dollar. They do that by selling dollars to buy their own currencies. That drives the dollar lower and the yen higher. We've had the Bank of Japan was doing that. We've had the People's Bank of China started doing that yesterday. The European Central Bank, the Swiss National Bank, the Bank of England, all the central banks around the world are fighting the Fed. And that's interesting because rule number one of investing is don't fight the Fed. Although I think that is meant to apply to you and me, Mish. I don't think that's meant to apply to other central banks.
No,
That's what's going on.
I would like the bond market has spoken.
Ooh, okay. I have not brought up the chart of the 10-year yield. Let's bring that one up. Are you talking about the 10-year?
Yes, sir.
Okay. Let's see what the 10-year is doing. You know what? Can't look at the 10-year on Yahoo Finance. It's too delayed. So let's look at investing.com. What is the 10-year doing today? So it's dropping a little bit right now.
Check out that candle.
Let's see. Let's put a candle on there. Yeah, the candles on this chart don't really show you much. You end up with a
go to the 15.
15-minute. Okay, there we go. Looking at 15-minute candles. Yeah, I can see that. Yields are dropping right now on this news. That's interesting. That means yields dropping. That means bond prices are rising. That means people are buying bonds based on this news, sending the yields lower.
And the markets are going up.
And the markets are going up. That's very interesting to see stocks heading higher with yields heading lower. That's not your typical risk-off situation right now. The Dow is certainly heading higher, looking at up 266 points right now, or 0.84%. The Dow is heading higher. That's interesting. The industrials are heading higher. The S&P is basically even for the day, barely budging, and tech is down, which, to be honest with you, if it were up to me, that's kind of what I would do. I mean, I think tech is way overvalued. People pay way too much for these companies with no earnings just because Kathy Wood made a moving, compelling TED Talk about something. Oh, yeah, sure, let's pay $100 trillion for this company with no earnings. Meanwhile, company like ExxonMobil is trading at some ridiculously low valuation at a time when they're just absolutely cash printing machines. So I would expect the Dow to be moving higher and the NASDAQ to be moving lower on any given day right now. Not necessarily on this GDP news, but just on an average day, that's something I'd expect. Not really a big move either way, to be honest with you. I really don't see the market reacting as a whole very much to what's going on with this GDP report.
Yeah,
we're certainly going to get it. What was that, Mish?
We'll see with open.
Yep.
Retail
I can tell you one thing, though. We're definitely going to get a lot of political jawboning nonsense off of this. I mean, Twitter, the Twitter recession, not recession debate is going to be, I guess, it'll be cute. It'll be funny for a little while. And then after like an hour, you're just going to be like, you know what, switch it off. Like, it's just going to be people talking past each other. But, one takeaway here is the not recession is over, right? I was beating on the table saying 2 consecutive quarters of negative economic growth. That means recession. Well, recession over. We got 2.6% growth. We're probably heading right back into one because something tells me the fourth quarter is going to be rather doo-doo with pension systems on the brink of failure, European banks on the brink of failure, tightness in the U.S. Treasury market. Not a lot of good news on the horizon. And again, those big tech earnings, man. Meta, Google, and Snap, those god-awful earnings. That's your advertisers, right? That's a good barometer of the health of the average company in the U.S. If they're cutting back their advertising spend, that is a bad signal. That is a really bad signal. All right, guys, I think we are going to wrap it up there. By the way, I did not say hi, Mom, and hi, Dad.
Well, I was going to say, hey, Mom and Dad, plus Sage just popped in, so say hi to Sage.
Hello, Sage, from Sage News Live. What's going on, brother? And
remember, if you can find me in the wild, you get a Merc dime.
catch Mish in the wild. That's right. Mish has a shiny Merc dime for anybody who can catch up with him. By the way, hashtag where's Mish?
Mitch is in Nebraska, back in Lincoln. And if
Still in
Andrew
Lincoln.
is watching, if you can find me, I'll give you a Merc dime.
Outstanding. Outstanding. Also, I want to send a shout out to my Patreon supporters. Thank you guys for everything you do for the channel. Had a good talk with Patreon yesterday. We get together once a week for a Zoom call, talking a lot about energy yesterday. Something to keep an eye out for in the coming days. There's a lot of talk about energy. There's a lot going on. Diesel inventory is getting very low. A lot of back and forth between the Saudis and the U.S. Let's just say that Joe Biden and Prince bin Salman in Saudi Arabia do not like each other, and that's bad for the oil markets. When personalities clash like that on a national level, that's bad for oil markets. And we have another OPEC Plus meeting on November 1st. Watch out for that, because the Saudi oil minister gave a speech on Twitter a couple of days ago, and in a nutshell, he said, you're rigging markets with your dumping of the SPR. He didn't call out the U.S. specifically, but he was alluding to it. And he said, you're going to live to regret that. So that could mean big production cuts on the horizon in oil markets. So just something to think about. We were talking a lot about that on the Zoom call yesterday. Link down to the Patreon below should you feel so inclined. And I think we are going to wrap it up there, folks. Headline number, GDP up 2.6%. And until next time, live small and dream big.